Amid the recent market turmoil, investors, both big and small, have the same question. What do I do with my money right now? Goldman Sachs Asset Management might have some answers. Joining us to discuss, Mike Thompson from GSAM Model Portfolios. Mike, great to have you with us. You've been de-risking.
Yeah, I mean, we just to level set, we'll be talking about our 60-40 fund, which is moderate, which is very popular. It's a 10 to 15-year outlook. And just for the record, we put out our instructions late Friday. So it's important to know that. But our views are long-term. You know, think about a pilot, right? You have storms, but you have to think about how to get to your destination. So, you know, dispassionate. In other words, we have to focus on where we think things are going 12 months and a day out, and we review quarterly.
So 60-40 is 60% equity, 40% debt.
That's
in your
the
allocations.
Benchmark,
within the equity bucket, where are you allocated to? What are you underweight and overweight?
Yep. So what we did is we trimmed back our small and mid cap exposure, and we stuck with the large cap. Liquidity is a premium there. I think the earnings picture is going to go. But more importantly, and even before the correction, you know, there's enough momentum in the economy to sustain, the valuation, the earnings picture there. And when you have valuations, and now they've dropped from with 17 handle down into the low 16, and you consider that relative to a sub 2% 10-year yield, you have to kind of take a look and think that, you're well positioned to take a chance and be modestly biased towards the growth story, and large cap's a good way to play it. That's the way we feel at Goldman Sachs Asset Management.
Mike, can I ask you about the credit market, putting your clients into, let's say, short duration credits under BBB investment grade, which I assume you use, under 3% yield. The dividend yields of the same companies that issue the credit are 2.4, 2.6%. How do you buy them those credits? This is the tightest spread I've ever seen in my life.
Yeah, well, look, we know our investors. Okay, we know our investors and we know what works for them. And also, we're making sure that we're thinking outcomes. We want the right outcomes. What we did this time, Kevin, is this. What we did is we took on a little bit more duration. We are more weighted towards higher quality credits, and we actually enhanced that position in this rebalance.
How long duration? How long?
We went from about 1.86 years to about 2.05 years
You're
in this
still
portfolio.
Under 3%, though.
Yeah. Yeah, indeed. But the reality is this is how we anchor the portfolio and manage the risk. Look, with these programs, we have 8 model portfolios. We're talking about the most popular one. It's the one where people have 10 to 15 years. And that's where the money is. That's where that boomer money is. And we have over $20 billion basically underlying this asset allocation that we advise on, right? So we have to be very careful to make sure that those risk parameters are observed, and we're thinking about the outcomes. So that's where we felt comfortable positioning ourselves in the fixed income.
We've talked a lot today about Bitcoin. We had a guest on who has 50% of his portfolio in Bitcoin. We won't discuss the merits of that. Have you contemplated including Bitcoin in those portfolios?
That's outside my purview. Other than what I hear referentially, but it is not something that, our core investors, they're sensitive to what we put in the portfolio and in the sleeves. So that would not be something that we'd be dabbling with.
One of the things that I think has gotten lost is how well 60-40 has done, because bonds have rallied so much in the first half of this year. It might have been the best 6 months in memory for that type of strategy. What are your return assumptions for the fixed income piece? Is that just going to be more for stabilization effects?
Indeed, and risk mitigation. And in fact, what happened is what we did is we were at 62.38, including cash, last September. We haven't rebalanced since. What we did is we reset that, and we took it away from fixed income and we put it to fund the overweight to equities.